If you are retired and you have a bank account, and of course you do, there is a new IRS enforcement rule that took effect in 2026 that you need to understand right now because it is already catching retirees completely off guard. And the penalties involved are not small. We are talking about fines that start at $10,000, and in many cases, the people receiving these penalties had no idea they were doing anything wrong. They were not hiding money. They were not trying to cheat the system. They were simply moving their own money the way they always have, transferring funds between accounts, receiving payments from family, depositing savings, and the IRS flagged it anyway. By the time they found out there was a problem, the penalty notice was already in their hands. I want to be very clear with you right from the start. This rule is not designed to go after honest, hardworking retirees who are simply managing their finances in retirement. The intention behind it is to catch large-scale tax evasion and unreported income. But the way it is now being enforced in 2026 means that ordinary financial activity, the kind that millions of retirees engage in every single month, can trigger a review, a flag, or in some cases, a direct penalty if certain thresholds are crossed without proper documentation. And because most retirees have never heard of this rule before, they have no idea that the way they are currently handling their money might already be putting them at risk. So let me explain exactly what this rule is, how it works, and what you can do right now to make sure you are fully protected. The rule at the center of all of this involves cash transaction reporting requirements that have existed for decades but are now being enforced with a level of automation and precision that simply did not exist before. Banks in the United States are legally required to report any cash transaction above $10,000 to the IRS. This is called a currency transaction report, and it applies to deposits, withdrawals, and transfers that meet or exceed that threshold in a single transaction. That part is not new. What is new in 2026 is the degree to which the IRS is cross-referencing these reports with individual tax returns, Social Security income records, and retirement account distributions to identify discrepancies and acting on them faster than ever before. Here is where it gets important for retirees specifically. Many retirees are moving money in ways that seem completely normal, but can trigger scrutiny under these rules. Selling a piece of property and depositing the proceeds, receiving a lump sum from a pension or annuity, moving money from a savings account into a checking account to cover a large expense, receiving financial help from an adult child, combining funds from multiple accounts before a major purchase. None of these things are illegal. None of them are even unusual. But when they involve amounts above $10,000 and the IRS does not see a clear explanation on your tax return, they can result in a request for documentation. And if that documentation is not provided correctly and promptly, the penalties can reach $10,000 or more. There is a second layer to this that many people are not aware of, and it involves something called structuring. Structuring is when someone breaks up a large transaction into smaller ones, specifically to avoid the $10,000 reporting threshold. For example, depositing $9,000 one day and $8,000 the next with the intention of staying under the limit. Even if the money is completely legitimate and fully taxable income that you plan to report, the act of deliberately breaking up transactions to avoid the reporting threshold is itself a federal violation, and the IRS and Treasury Department have become significantly better at detecting it through automated pattern recognition systems that monitor account activity over time. The $10,000 penalty applies here as well, and in serious cases, additional consequences can follow. Now, I want to reassure you because none of this means you need to panic about every transaction in your bank account. The vast majority of retirees who are simply spending their Social Security, their pension, and their savings in normal ways have absolutely nothing to worry about. The IRS is not looking to penalize people for paying their bills, making normal purchases, or managing routine expenses. What triggers problems is large, irregular, or unexplained movement of money combined with a tax return that does not account for it clearly. The most important thing you can do to protect yourself is to maintain clear documentation of any large financial transaction you make. If you sell a vehicle, keep the bill of sale. If you receive money from a family member, keep a written record of what it was for. If you transfer a large amount between your own accounts, keep a record showing both accounts belong to you. If you receive a lump sum from a pension, annuity, or retirement account distribution, make sure that amount is properly reflected on your tax return with the correct forms. Simple, organized record keeping is genuinely the most powerful protection available to you. If you are not currently working with a tax professional, and your financial situation involves regular large transactions, rental income, investment distributions, or any income sources beyond standard Social Security and a pension, this is a very good year to start. A qualified tax preparer or CPA who understands retirement income can make sure your returns are structured correctly and that every dollar moving through your accounts is properly accounted for. The cost of that professional guidance is a fraction of what a single penalty notice can cost you. It is also worth having a conversation with your bank. Ask them directly what reporting they are required to do on your account activity and whether any of your recent transactions have triggered any reports. Banks cannot always share every detail, but they can often give you general guidance and alert you to anything that might need clarification. Being proactive with your bank is always better than being reactive with the IRS. The 2026 enforcement environment around these rules is more active than anything retirees have experienced in recent years. The systems are more automated, the cross-referencing is more thorough, and the response times are faster. But the retirees who will be caught off guard are not the ones who are informed. They are the ones who assume these rules did not apply to them because they have always managed their money the same way without any problems. You now have the information you need to make sure that does not happen to you. Keep your records organized, report your income accurately, ask questions when you are unsure, and work with a professional if your situation calls for it. A little attention to this now protects everything you have worked so hard for.
Yeah, grind mode on, can't kill my drive. Turn the pressure up, I come alive. Grind mode on, I don't fold, I don't quit. Hunger in my chest, every beat I commit. Eyes on the prize, no sleep till it's won. World in my hands when the grind mode's on. Wake up with a vision, I'm locked on the target. Turn pain into fuel, I'm a flame, I spark it. No shortcuts here, I embrace every test. Pressure on my shoulders, still I handle it best. I was made for the climb, every loss, every scar. Built me in the steel, now I shine like a star. If the road gets rough, I just double my speed. Ambition on 10, I was born to lead. Grind mode on, I don't fold, I don't quit. Hunger in my chest, every beat I commit. Eyes on the prize, no sleep till it's won. World in my hands when the grind mode's on. They said limits exist, but I shattered the frame. Every wall in my path is just fuel for the frame. Discipline heavy, but my spirit is free. I don't chase success, success chases me. I'm the storm and the calm, I'm the rise, I'm the proof. Every bar that I drop is the grind in the booth. Blood, sweat, tears, that's the code I trust. I don't wait for the crown, I earn it, I must.